Meta just reported the fastest revenue growth since 2021. Beat earnings, beat on ads, beat on almost every metric analysts were watching, and the stock dropped 10%. Today, I'm going to explain exactly why and whether that sell-off was rational or a massive opportunity. The actual results were strong. Revenue of $56.3 billion, beating estimates by nearly $1 billion. Adjusted EPS of $7.31, beating the $6.79 estimate. Revenue growth accelerated to 33%, the fastest since 2021. Ad impressions up 19%. Ad prices up 12%. On the surface, this was a clean beat across the board. But look at the EPS quality carefully. The headline earnings per share was $10.44, which looked like a massive beat. But that included an $8 billion one-time tax benefit. Strip that out and EPS was $7.31. Still a beat, but not the blowout the headline suggested. Underlying earnings only grew 14% year over year. Markets noticed. Here is the number that triggered the sell-off. Meta raised its 2026 capital expenditure guidance to between $125 and $145 billion. That is up from the previous forecast of $115 to $135 billion. To put that in perspective, Meta's 2026 Capex is larger than what they spent in 2024 and 2025 combined. Why did Capex go up? CFO Susan Lee explained on the earnings call. The main driver is higher memory pricing. The same HBM memory chips that sent Micron up 33% last week are making Meta's data centers more expensive to build. The war in Iran disrupted supply chains, which pushed component costs higher. Meta is not spending more because its strategy changed. It is spending more because everything costs more. There was a second concern: user numbers. Daily active people fell slightly quarter over quarter, the first sequential decline in recent memory. Meta blamed two specific causes: internet disruptions in Iran due to the war, directly affecting user access to Facebook, Instagram, and WhatsApp, and Russia restricting access to WhatsApp. Year over year, users are still up 4%. But a sequential dip in a company valued on user growth always concerns investors. Reality Labs, Meta's metaverse division, made $402 million in revenue and lost $4 billion and $30 million. That is a loss of nearly 10 times its own revenue in a single quarter. This has been happening every quarter for years. Meta is simultaneously funding the metaverse, spending $145 billion on AI infrastructure, and cutting 8,000 employees. Investors are asking, how many bets can one company afford at once? JPMorgan downgraded Meta from buy to neutral after earnings. Their analyst wrote that full-stack AI competition is intensifying, and Meta has a more challenging path to converting heavy AI Capex into returns beyond advertising. That is a significant statement from one of Wall Street's most influential banks. However, 88% of 69 analysts covering Meta still say buy, with an average price target of $855. JP Morgan is the clear outlier. But here's the question that every investor in Meta needs to answer, and most people are getting it completely wrong. Here is what the market is missing. Meta's AI investment is already generating real, measurable returns right now. AI model upgrades improved ad conversion rates by over 6%. The value optimization suite is generating over $20 billion in annual revenue. Threads hit 150 million daily active users. Business AIs are handling 10 million conversations per week. The Capex is not funding future hope. It is expanding something that is already working. Look at this valuation comparison. Meta is growing revenue at 33%. Alphabet is growing at approximately 12%. Yet Meta trades at 18.8 times forward earnings, while Alphabet trades at 30.8 times. Meta is growing nearly 3 times faster, but trading at a significant discount. On pure fundamentals, that gap is difficult to justify, which is why 88% of analysts say buy. But the bears have real points too. Meta lost 2 youth safety trials in March. The CFO warned on the earnings call that future cases may result in a material loss. Simultaneously, Meta is cutting 8,000 employees while raising capital expenditure to $145 billion. That combination, massive spending increases plus major legal exposure, is what makes the bull thesis genuinely uncertain rather than obviously correct. Here is where the stock sits right now. Meta peaked near $742 earlier this year. After the earnings drop, it fell to around $610, forming what technical analysts call a falling wedge pattern. The $600 level is critical support. The average analyst price target is $855, suggesting over 40% upside from current levels if the bull case plays out. Here is the complete bull and bear case in one table. The bulls say 33% revenue growth, the cheapest valuation versus peers, and AI already generating real returns makes this a compelling buy. The bears say $145 billion in spending with no clear monetization timeline beyond advertising, mounting legal costs, and a user growth plateau is a structural problem. Both arguments are rational. Which one you believe determines whether $610 is a bargain or a trap. Here is the single number that will resolve the Meta debate. Q2 operating margin. In Q1, Meta delivered 41% operating margin despite the Capex surge. Management guided for full-year operating income above 2025 levels. If Q2 delivers at or above 40% margin, the Capex is not compressing the core business and the bull case is intact. If it drops materially below 40%, the bear case gains real traction. Watch for that number in late July. One more concern investors flagged: revenue growth is decelerating. Q1 was 33%. Q2 guidance implies about 25%. That slowdown is real, but look at the absolute numbers. Q2 revenue is expected between $58 and $61 billion. The percentage slows because the base gets bigger, not because the business is weakening. Context matters enormously when reading deceleration in a company this large. Here's the context that rarely gets mentioned. Google is spending $180 to $190 billion on Capex this year. Microsoft raised its guidance. Amazon raised its guidance. Every major tech company is spending at this scale. Meta's $145 billion is actually below Google's spend. Yet Meta is growing revenue faster than all of them. The market punished Meta for spending what everyone else is spending, while generating better growth than everyone else. The market is asking the wrong question. The question is not whether Meta is spending too much on AI. Google is spending more. The real question is whether Meta's advertising business is strong enough to fund that spending without destroying margins. In Q1, the answer was yes. 41% operating margin while spending $145 billion is extraordinary. AI is improving ads. Ads generate more cash. Cash funds more AI. That self-reinforcing loop is the entire Meta bull case. What should you actually do? If you already hold Meta, the thesis has not broken. Watch Q2 operating margin in late July. If you are considering buying, wait for the July confirmation before committing significant capital. The $610 level is holding support right now. A break below 600 would be a meaningful technical warning. A hold above that level into Q2 earnings suggests the market is digesting the Capex news rather than genuinely repricing the business lower. I am Marcus. Drop a comment. Is Meta's sell-off a buying opportunity or a warning sign? I genuinely want to know where you stand. Subscribe for daily market breakdowns. I will see you in the next one.